When we think about saving for retirement, we often think about accounts like 401k plans, IRAs, Roth IRAs, etc. And while these accounts do have great tax benefits for long-term investing, there's another type of account that's often overlooked that can also have amazing tax benefits and flexibility when you retire. So in this video, I'll show you how you can take over $120,000 in income from this account in 2025 completely tax-free if the circumstances are right. And spoiler alert, it's not a Roth IRA. Hey everyone, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. My company and my YouTube channel here are both dedicated to giving you more confidence and clarity with your money. If this is your first time here, please consider subscribing to the channel to stay up to date on any future videos related to investing and retirement. So I'm not going to keep you hanging. This account that I'm referring to is called a taxable brokerage account. It's also known as an after-tax account or a non-qualified account, some people call it. And the reason it's called a taxable brokerage account is because it's an ordinary investment account. It doesn't have any specific retirement tax characteristics like IRAs and 401ks. And you pay taxes on interest, dividends, and capital gains in these types of accounts, whereas in retirement accounts, those are all deferred or not taxed at all. So to understand how you can take six figures of income from this type of account without paying a dime in taxes, we first have to understand the two primary tax schedules that we have under the US tax system. First is ordinary income, which is the tax rate that you pay on your salary, your paychecks from work, business income, IRA withdrawals, pensions, etc. So that is taxed at one schedule, and it's a marginal tax system, meaning you pay different percentages on different portions of your income as it increases. And the second tax schedule that I'm referring to here is regarding capital gains. That's just selling an asset for more than you bought it for. It can be real estate, it can be a business, it can be stocks, bonds, or mutual funds. And there's two flavors of capital gains taxes. You can pay short-term capital gains taxes if you held the asset for less than 1 year. In other words, you bought it and then you sold it less than a year later. And then there's long-term capital gains rates, which are more favorable, and it's if you held the asset for more than 1 year. For short-term capital gains, the tax rate is the same as your ordinary income tax bracket. So let's say, for example, your adjusted gross income is $100,000, and that's, again, your income after deductions. That would put you as a single filer in the 22% tax bracket. Now let's say that you bought a stock for $1,000 in January of this year. You sold it in June of this year for $1,500. You would pay short-term capital gains taxes, which would be 22% for you on the $500 gain. However, if you held that stock for longer than 1 year, you would pay a more favorable long-term capital gains tax rate, which can be 0%, 15%, or 20%, depending on your adjusted gross income. So going back to that same example, if your adjusted gross income is $100,000 as a single filer, that would put you in the 15% long-term capital gains tax bracket. So if you sold that stock for a $500 gain, you would then pay 15% instead of 22% like you would if it was a short-term gain. So as you can see, the long-term gains are more favorable, and that is the government's way of incentivizing you to hold your investments long-term. Now, the important part to remember here is that when you sell a stock in a taxable brokerage account, you only pay taxes on the gain, whether it's short-term or long-term. The cost basis in this example, that $1,000 that you paid for the stock, that's just considered a return of basis, and you don't pay any more income taxes on that. So where this can be really powerful for retirement income is, you might have noticed on that chart, there's a 0% long-term capital gains rate if your adjusted gross income is below a certain level. And the other thing to keep in mind is that these tax rates are based on your adjusted gross income. So if you add back the standard deduction, which the vast majority of people take, as a married couple, you can really earn $126,700 in gross income, which includes those capital gains, before you pay a single dime in capital gains taxes. So let's look at another quick example and show you just how powerful this can be for retirees. Let's say we have a married couple with $1 million in IRAs, and they have $400,000 saved in their taxable brokerage account. We'll say that $200,000 of that balance is considered their cost basis, and the other $200,000 has been their gain over the years that they have yet to realize. Let's say they just retired, they're not taking any Social Security yet, they haven't started taking money out of their IRAs, they don't have a pension or any other rental income, so their ordinary income is $0. In reality, I realize that most retirees will have at least some sort of earned income, whether it be from interest or Social Security, but for simplicity, let's just say they have no other sources of income right now. So if they have $0 in income, technically they can earn up to $126,700 in income through their capital gains and still pay $0 in taxes. And what this means, since only half of their brokerage balance is considered gains and the other half is considered cost basis, is that they could really sell $253,400 of investments and withdraw all that money for income if they wanted to in retirement without paying a single dollar in taxes. And to my single people watching this, I didn't forget about you. In this same situation, you could still withdraw over $100,000 tax-free from this brokerage account because, again, only $50,000 of that would be considered capital gains, and that would still put you in the 0% tax bracket after the standard deduction. And one other thing on this note, the long-term capital gains tax brackets are marginal, just like the ordinary income tax brackets are. So this means if you go $1 over that 0% threshold, that doesn't mean your entire capital gain is going to be taxed at 15%, only that next dollar will be taxed at 15%. Now you might be asking why these retirees would sell $253,000 of their investments if they don't need all that money for income. And the answer to that is called tax gain harvesting. Tax gain harvesting is essentially utilizing the 0% capital gains tax bracket to its full extent and simply repurchasing investments with the money that you don't need, so it resets your cost basis at a higher level, making any future sales less gain and more cost basis. So think of tax gain harvesting like setting a new high water mark. When you sell your investments at a gain and repurchase them at a higher price, that means when you sell them again in the future and you actually need that money for income, less of that sale is going to be subject to capital gains taxes, if at all. So now that we understand how taxable brokerage accounts work and how to take advantage of those favorable tax rates, a couple situations where this could be extremely beneficial would be number one for early retirees who want to keep their income low so they qualify for premium tax credits for healthcare. When you buy health insurance on the marketplace, you can qualify for premium tax credits based on your income. So by using a taxable brokerage account, when you sell those investments that you have, again, a lot of that is going to be a return of basis to you, which is not taxable or included in your income. The second situation where this can be extremely beneficial for retirees is to help you avoid IRMA surcharges. Once again, since only the gain is considered income, and that's what IRMA surcharges are based off of, it can allow you to take a pretty substantial withdrawal before you're pushed into those IRMA tax brackets. So whether you're still decades away from retirement or retiring soon, I encourage you to try to incorporate one of these accounts into your retirement plan for that ultimate flexibility and those favorable tax rates. If you want to download the worksheet that I've been referencing throughout this video, you can do so at the link in the description below. And if you are considering working with a financial advisor to build you a tax-efficient retirement plan, we are accepting new clients at Spark Wealth Advisors, and we would love to speak to you. You can schedule an introductory meeting at the other link below. Thanks for watching, and we'll see you in the next video.